All right. Welcome to the Bullish on Bitcoin stream podcast. We're still not quite sure what to call it. This week's edition is all about cross-chain bridges, cross-chain security, and also Bitcoin cross-chain trading. We have a special guest with us today, Philipp Zentner, CEO and co-founder of LI.FI, who has been in the space, again, for a long, long time. I guess has seen it all in terms of cross-chain interoperability and has built LI.FI into one of the most successful cross-chain providers in the space. So yeah, Philipp, thank you so much for joining.
Alexei, thanks for having me.
Before we dive in, obviously a question people always love to hear and would be super nice just, to get a quick 2-minute TLDR. How did you get into basically cross-chain bridging and cross-chain swaps? And how did you end up building LI.FI?
Yeah, my co-founder and I, so Max and I, we have been building companies 10 years prior to this already. And we built in gaming and biotech, marketplace intelligence. I have a strong data background. And when we came to crypto beginning 21, looking at the blockchain as what it is, like a public database, we knew it has, like physically, it would not be enough to keep it like that. Decentralization comes as at a price, right? So that's was very, very clear. It would have to fragment, and then we immediately saw the first indicators with Optimism Arbitrum sponsoring the Interop hackathon, which was our first hackathon we did together, and it was kind of a no-brainer to do what Stripe did for payments, which is like aggregating hundreds of payment gateways. Do the same for crypto. Aggregate anything that provides access to assets and allows to move and trade them. So we started as a bridge aggregator, but pretty quickly we added DEX aggregation on top of it, and nowadays even perps and yield and prediction markets. So essentially we are an investment API for DeFi nowadays, and as such we have been doing around $80 billion in transaction volume for over 1,100 active B2B partners.
Cool, that's really impressive. You guys also recently released an Earn product, so essentially an Earn API that lets you directly deploy into DeFi. Do you see more demand coming from that? Like what drove you to expand beyond like swaps and bridging to like dedicated DeFi actions? I mean, it has been theoretically possible for a while and tried before. Do you see like a resurging interest now?
Yes, for us, it was always clear that we would expand towards other transaction domains in general, and yield aggregation was probably a very natural demand that occurred around the whole DeFi mullet thesis. And that's also like when people saw Morpho getting traction, being directly integrated, they were like, well, actually, I would love to offer yield to my clients too. Many of our customers reached out, asked for it, and here we are.
Cool. I mean, talking about interoperability, I mean, cross-chain swaps, bridging has been around for as long as I can remember, smart contract chains emerging. What do you think, and I guess from your perspective, has changed most in the last 1 to 2 years? I mean, we've seen the rise of intents. So bridging has somewhat changed from users having to, use burn-in bridges or liquidity bridges towards intents, where essentially a user basically tells you what they want, and then market maker solvers in the background perform all these actions. Do you see that having a major UX impact and improvement to bridges, or do you still think that it's a big, like, UX is still an issue and we'll still see fragmentation of different protocols and approaches?
For me, intent systems are not a progression towards bridging. It's just a different architecture on how to conduct bridging, and there are different advantages and disadvantages to all the three forms we essentially know of, which is like minting and burning of assets. Here we have finality risk, but like super capital efficient. Because we take finality risk, it's slow. So on top of that, the second design is liquidity networks, something like Stargate, which has liquidity pools on multiple chains. It's not capital efficiency here is questionable. However, it's super fast. You have lock and release mechanism, and that's faster than mint and burn. And then you have intent systems where you delegate the execution to third-party solvers. However, these solvers operate on mercenary capital, and they typically accumulate where the demand is densest. So there you have it's super fast and cheap. At the same time, you have the issue that we are operating in a very fragmented market, and that's not covered then. So this is again where like LI.FI shines, right? Because you have all these bridges aggregated, and you make use of all the advantages all these different systems bring to the market. You cannot get around it without aggregation, essentially. And then the second question was kind of what we have been seeing in the past 2 years, how things have changed, right? It is sure intent. So we saw a lot of bridges releasing intent systems. So I carefully phrase it like that. They released intent systems on top of what they have been before. So many bridges are essentially 2 bridges, or like some bridges have like 4 different APIs to implement. Yes, certainly driven by the narrative. At the same time, we have seen bridges consolidating. So many bridges died. At the same time, many bridges transformed themselves into becoming a solver themselves because they're releasing intent systems. And then they realize, well, they can't make any money. And then they realize that the solvers underneath them can't make any money either. So many bridges have become very, very centralized. However, what has changed to the bridges that were centralized 4 years ago, bridges were centralized and the money they would use was raised from the community. Now bridges are centralized, but they do it from their own balance sheet. So they take their own risk. So essentially the user is off the hook. It still is it only becomes dangerous in a way, or mostly in a way where if too many players are like, oh, this is super fast and cheap, let me implement that bridge, then if that bridge gets too much power and it's fully centralized, then you have a systemic risk that can't be prevented. So again, like here, bridge aggregation is important, and that's again where LI.FI comes into play. And it's like, okay, whatever. It has always been our value proposition. We have always been saying this space is changing so fast. You should be protected from what happens down there. You end up with a mess of integrations, maintenance overhead, communication overhead, what's coordination, optimization. So we do that as a company, and we grew to 130 people by doing that. And yeah, rightfully so. And I don't see this being the end of it. Like bridging, Interop is solved in many ways, but there are new concepts on the horizon. There are still new bridges being released. There are still new challenges being tackled, like Bitcoin is one of them, right? Especially here we saw like Rift, Flashnet, you guys, many other Bitcoin bridges coming around. And yeah, exciting to keep on watching this.
I mean, the way that the bridging looks like, if I look at bridging today, it kind of burns down to a few layers, right? You have at the bottom, when you have some burn and mint bridges at the core, you can't really, I guess you can still use liquidity bridges to just do swaps, but ultimately the question is, unless there's really a lot of demand and like people go in and out, which is rarely the case, right? Like there's usually directional flow. There's demand for DeFi and some chain or incentives or on new chain launches, and there is usually some directional flow in one way. It's very rare to see like maybe between Ethereum and Solana where like there's like bigger chains where like the demand is quite balanced. So you'll always end up with a very directional flow. And at the end of the day, what kind of you need underneath is a burn and mint bridge, right? And you have a lot of asset issuers like BTC wrappers, stablecoin wrappers that actually have these burn and mint bridges, and they pick one infrastructure provider of their choice, be it layer 0, CCIP, be it something else. And on top of that, right, you have these liquidity bridges, intent systems. And I think, the recent incident with the KelpDAO hack and layer 0 actually show that at the core, this is the infrastructure that is still carrying the most risk, and actually all bridges and most bridges actually are exposed to the operations of a few providers in the space, right? If I look at the very core very base layer of interoperability and how chains can talk to each other, there's only a few providers left at this point. So it is quite centralized just because it's a winner takes it all market, and an issuer will pick one provider, and that's where these deals have been won in the past, right? Like USDT worked with layer 0 to create USDT 0, right? So they basically dominate that stablecoin market. You've had attempts by Chainlink to create OpenUSDT that didn't get as much traction. What do you see happening in the next 1 to 2 to 3 years at this base layer? Because ultimately, we can build intent bridges, we can build everything on top, improve UX, improve like speed and efficiency, but we need to rebalance between chains. We can always fall back to centralized exchanges, but that doesn't really sound like a very reliable source of like moving assets to Binance and then withdrawing to another chain. That I feel like it's not that much better. I mean, definitely better than the one-on-one BVN that KelpDAO kind of was operating, but I'm a bit biased to say that we can do better.
I believe we will see more fragmentation as a result of the layer 0 KelpDAO thing. Chainlink and Wormhole are going to get more traction. Circle recently bought Axelar. I don't think they will be the last messaging bridge around. There's Hyperlane. There are like other small ones or Polymer as a technology that could also be revamped. There's was it Unity? It's another one. Like there are plenty of smaller players in the space. It's going to get scooped up and then used to as alternative mint and burn solutions. Lucid, another one. So there are lots of smaller players around the minting, burning, messaging layer, and I believe that as more and more institutions come in, they will, once they get the understanding on what's out there, they might want to own this part of the stack as well. There is just like a strong incentive to do so because that's what they're used to. It's like if you look at banks, like JP Morgan, it's not just a bank, it's a financial institution. It does everything. There's nothing it's not doing, right? And we're gonna see the same behavior and desires in crypto. It's the same and we see that kind of consolidation also within crypto native, like these players like Aave, Morpho, or Stargate, all these bridging players, even LI.FI, like we also, vertically integrating more and more. But just to, like for LI.FI is special, like I think we do it in a very fair manner. So LI.FI really tries to be market neutral or is market neutral. So even if we have our own solutions, we let them compete in a fair way with anyone else. And we also want to provide proof of best execution. I think it's very important for our market positioning. It is not for the others. Others should vertically integrate and go aggressive. Like for us, it's not. For us, it's really like we do the plumbing essentially. We are core financial infrastructure for this space to be able to mature and find adoption fast, right? Like someone has to make sure that if another 10,000 institutions want to come in tomorrow, they can go to market fast without having to implement 100 APIs. That's what we essentially take care of. Yeah, so that's around consolidation and so on, just to close the loop with LI.FI.
I mean, it's a good point. I mean, I think like a small correction point there. I think like Circle acqui-hired a team, but Axelar still operates as a standalone network. I think just the founding team got acqui-hired, which is similar, right? But essentially, it's like
the only political way to do it after you raise $200 million and you have a token out.
Yeah,
great show.
Yeah. I mean, I'm not going to comment. We're good friends with the team, so I'm not going to comment.
I like them too. I haven't caught up with them yet. But of course, that's my read from afar. But probably pretty logical. Maybe I'm a bit too German here right now.
But I think it's tricky, right? With all these acquisitions, and I mean, before we go too much off topic, right? But how do you buy like the network, right? I'm sure if it was easy, it would have been done. But it's easier just to buy out the core, to get the team integrated to build on your own infrastructure. In the case of Circle with CCTP, than trying to buy an entire new network that does a lot of other things.
I have seen four infrastructure products with token unwinding the token in the past 6 months. One is the most public one across. Then there are a few other non-public ones, but you will hear from it soon. So more and more projects are doing it because like that token equity confusion is a thing. I still believe in token, but it's just not the market for it. It's just too early. Like if you think, it depends really on what kind of a founder you are. What your goal, what your motivation is. You want to have a quick cash grab, do your token. If you're here to stay, if I look at LI.FI, like we're looking at a decade-long transition of TradFi coming on chain. I'm building $100 billion company. Just make sure I'll survive and not sell. That's it. No brainer. It's just another 10 years away.
There is,
so there's not that many.
There is an argument for tokens, right? It just depends how they're done, and like not every product needs a token.
Agree, but I also don't see any. The capital is too mercenary. It's just like it's such a distraction too. It's just that there's not a good market for. There's not the liquidity depth in this space is in my opinion not deep enough to launch a token, because the public market here on chain doesn't look like the one we know from stock markets. It's just very early. And then you have to pull 2 legs out in order to keep the token price high and whatever. I don't know. Surely you can do all of that. But yeah, I look at my view is a bit pessimistic on it. Short to midterm.
That's fair enough. I think there's definitely an issue with tokens right now. Many are getting launched without any clear ties to the product. Teams have to pivot, but then essentially the tokenomics just stay separated. I do believe that for protocols to, like, it's a very powerful tool to allow people to buy into a vision and a protocol, and if there's a way for them to contribute and play a role. And like, here's my bull case for tokens, right? Say you're launching a new product, right? And how do you get people excited? How do you let people participate and own and be part of this, and have a stake in actually, giving you feedback, spending time? Referral programs kind of work, but then how do you fund them? And especially if it's a pre-PMF product, you might have to iterate many times before you can implement. Like, referral programs are usually built well on something that works. It's a good product. I think, and to be fair, it has worked in the past, and I do think it's a very powerful tool if done correctly. Now, what doesn't work, and we've seen in many cases, is that you have these huge airdrops that basically all go to farmers, and it's a very mercenary group of people that just moves around. I think there was a very good moment, and there were some success cases with like points programs and so on, but then as soon as everybody starts doing it, it becomes an industry of people where people can make money easily from airdrops. But I wouldn't write it off completely. I do believe that it's a very powerful tool that you do have if used right, in the right way, versus a startup that doesn't have it. Especially if you're trying to build a B2C facing product. If you're purely B2B business, yeah, then it becomes questionable of why you need a token. If you're building a purely B2B like integrated product where institutions perhaps integrated, why does it need a token, right?
Sure, a token can help bootstrapping a network. At the same time, we've seen like none of these networks are actually sustained, right? Like so I feel like if you need a token to incentivize someone to use you, then the problem you're solving is not big enough.
Yeah, I wouldn't say no. I mean, incentives are like pouring oil into a fire, right? There has to be something there for people to go and use it, right? I mean, user acquisition can be done in multiple ways. While PayPal was giving away money to get people to get on the platform, recommend, right? So it works if it's a good product. but I do see, tokens being able, like they allow you they allow for people to build identities around the grander vision and own and buy into it early. Example, like I've been a Revolut user from day one. Like I moved to the UK and I needed a bank account and Revolut was just launching, right? I was on the waiting list. I
Yes.
joined like in the first batch.
They
I've
solved a
been
big
a
problem
power
for you.
user. Yeah, sure. And I've been recommending it to friends and I think it's a great product. If this was done on chain, or like if it was like a product where I could have easily bought in, and I think that's perhaps, the advantage of tokens, where there's a lot of disadvantages of being publicly traded so early, like 100%. But there was no easy way for me to buy into Revolut and like go and like actually, recommend it to friends and businesses and have like a reason to do so. Or because, well, I don't own anything there. Like I like it, it's a good product, but I gain nothing by actually, recommending it to people. Like there's a referral program, but, for me, it's like, yeah, I mean, I don't care about this $30 lottery that I might win or not if I refer a friend and I have to give them my referral code. So I do feel that, buying into something helps me build that identity around it and binds me as a loyal user much stronger. And we see this with Chainlink and their like Link Marines. You see this, like Thorchain is actually an interesting example where the Thorchain community was the reason why Thorchain got so big. It also contributed to the fall and like to too strong risk appetite. And I have a very different opinion to the current community in their views of whether North Korea should be, laundering or moving money through Thorchain unchallenged or not. But you have to grant it to them. They have a very loyal and very strong community that believe in the vision, and because also they have bags, right? So I think, it can amplify and help you build a very loyal following that will go defend you. And it depends on what you use it for. Like
Yeah. I think a good example of that is the chaining community, right? Like I haven't seen a community as powerful as that one. And certainly other communities like Layer Zero, they also have an amazing crowd of people. But so has Jumper Exchange, and we don't have a token.
Don't get me wrong. I'm not saying like.
I also feel like I'm totally with you. I think long term, especially, like I'm looking forward to tokens being a more positive thing. Just like it has been abused too much from community and investors. It's just like a very abused tool, and so the market needs to mature. And might be even a better time to launch a token nowadays.
I mean, honestly, like I can't agree more with like the abuse point. Like 99% of the tokens out there make no sense, and there's like the amount of crime that's going on is ridiculous, and the amount of people that will approach you the moment they hear that you're doing a token and try to tell you to do some crime is ridiculous. Like this is one of the, like when Bob was launching a token, it was like that was one of the worst times I had in this industry, because there's so much like dealing with exchanges and like, you don't want to talk, it's not talked enough publicly, to be fair, and not necessarily the topic for today, but there is a dark side to it that I hope, gets washed out over time. And that is perhaps a reason why, regulations perhaps are necessary to prevent some of the things that are happening in the market, because ultimately who suffers most, it's actually the users and retail who buy into the vision and then get rugged. But yeah, just also to clarify, I think, tokens are not necessary, and Li.FI is, I think, a very great example of, building a successful business with a very good product where you don't need a token. I'm sure you thought about what would have happened had you ever launched a token.
Of course,
would have been useful
of course.
Or not.
Oh my god, it's been countless hours of internal debates. Should we have a token or not? What about Jumper? What about LI.FI and all of that? I'm so glad we don't have one. Like we are drowning in work and we're trying to make all the right moves. It takes so much mental capacity. If I imagine I had a token on the side, I would kill myself. So I'm happy we don't have it yet. LI.FI is still day one. Like I'm gonna fucking 100x this company. So there's a long time to go until we need to raise money from the public.
Right. Moving it back to the cross-chain topics that we started on. One of the interesting observations, if recently has been the role of aggregators in providing the best routes and products to their customers. And naturally, right now, aggregators to some extent are gatekeepers, right? For the audience and those who are not as deep into the cross-chain routing and swap space, the way it usually works today is you have the big wallets, the big institutional businesses, right, that have big institutional clients or a lot of retail users, right? Ledger, Trust Wallet, MetaMask, you name it. Now, they rarely will go and integrate a dozen or more protocols or 30 protocols themselves. They will do this for very big partners, very big protocols that drive a lot of volume. Then they will potentially do a direct integration. But when they get started, it's very painful for them to maintain these integrations. There's a very high cost, and that's essentially the customers that Li.Fi serves and others. But what happens then when a new protocol comes online, right, they are essentially competing against other protocols on the aggregators. And aggregators essentially are a great tool because they show you the best price. They basically let you compare as a user. You don't have to believe the numbers that one competitor might tell you about the others. You can actually see it. Now, one of the issues that has been happening, however, is that players start overquoting, right? Giving you much better quotes than they actually deliver. And we've seen this across aggregators in the space. I know that Li.Fi has been fighting this internally and implementing measures. And we've seen also 0x come out quite aggressively, right, accusing cross-chain swap providers and specifically, it was same-chain swap providers primarily, and then aggregators that focused on like DEXs. And at the same time, there was a debate around prop AMMs on Solana, giving you much better quotes than they actually execute, just to get the order. And then, because most users in wallets are not as price sensitive, right? Like wallets usually charge like 1% on top, even in cases, because users are happy to pay for the convenience. So the user isn't as price sensitive on like about a few bips, but they actually get cheated on.
Yeah.
What's your view on this? Is it like a natural market development, or is it something that really we should fight against?
I mean, yeah, that comparison you saw was done very unprofessionally and very shady. So we didn't get contacted. They were comparing apples with oranges. So that was a little bit off, unprofessional. So
everybody has an agenda, right? Like definitely.
Yeah, well, but your number one thing should be operate after high integrity and be professional. And we have always been doing that because, Li.Fi also has been releasing tons of comparison frameworks. Whenever we did that, we spoke to each and every team. We let them pass on each and every single word we have written about them. Like that's how you do it. That's how you, do something correctly and respectful. They have been just ape-shitting it on their Twitter timeline.
But beyond, like the marketing aside,
there was
just like
a frustration around that.
Of the general position of aggregating.
Spoofing is what we're talking about. So a big trend we have been seeing with DEX aggregators is the implementation of prop AMMs, and you cannot really control. It's really hard to control what the prop AMM underneath the RFQ is actually doing after you got a quote, and there's game theoretically speaking an incentive for these players to misquote. If they can make $50,000, it's worth the penalty they might face. At the same time, you can't lose prop AMMs as an RFQ because that's really makes a difference in terms of pricing overall. So, that one prop AMM might fuck you over in 1% of the transactions, but 99%, it's fine. But of course, they're going to fuck you over at those transactions that matter, where like $1 million is being swapped. So that's kind of the issue. It has been an issue for quite a while. It's the issue for all the DEX aggregators in the same way. And that's just the nature of this. And there are measures to prevent this. I actually personally can't go into too much details. I'm not informed enough. My team works a lot on this at the moment. But that's something that we've been seeing, and it's like this. It's like the competitiveness that drags people to, hey, let's onboard more prop AMMs, more market makers to quote and provide better pricing. And they often can do it because they might just be able to trade cross asset class, which allows them to price even more competitive than DeFi native solver might be able to do.
I think, there's an interesting dynamic here, right? Because just like how protocols compete against each other to get surfaced in aggregators, in the space where aggregation has become quite an interesting and lucrative business, many other players have started aggregating it as well, right? So you have LI.FI, you have SwapKit, and there's more players like there's Swap6YZ. There's more players moving into the market trying to capture, they compete for the same crypto to crypto market, but then everybody's trying to find their vertical outside. Ultimately, that's what also, of course, means whether they survive the business, in the business or not. And then we've seen some aggregators do more than others, some aggregators do less. Where we see it most is on the Bitcoin side, right? We operate in the Bitcoin space, and the easiest thing to see whether an aggregator is doing this properly is a lot of protocols out there will tell you like Bitcoin swap times are 2 minutes or 1 minute, which is absolutely not true because Bitcoin blocks take 10 minutes, right? You can't go faster on average. And we see this, and people just show that, and some aggregators are able to, they actually filter and check. Others just don't have the capacity, right? And at the same time, you're competing. And if all your competitors are just telling their users, hey, it's 2 minutes, and you're honest, you're actually, at a disadvantage. How do you
this
deal
is
with
exactly the thing? Yeah, this is exactly the thing, right? People always think, oh, aggregation is just implementing APIs. No, it is not. There is so much we are building around this, from actual transaction simulation, leveraging data telemetry, tracking bridging times, for example, right? Tracking success rates, having automated system to shut these systems off if they are failing too often, homogenizing data to make that available, transaction tracking, customer support tooling. Where is my transaction? Is it stuck? How do I unstuck it? How do I automate that at scale? How do I optimize then all of this with caching and reduce the amount of requests I have to send to these players to respect their APIs and infrastructure. There is so much we are building. DeFi is 130 people. We see some players like MetaMask, Phantom aggregating aggressively. Sometimes I feel like they have no clue what they're running into yet. We'll see. I mean, they have enough resources. They made so much money over the past 2 years, so they can certainly start building, copy everything. But at the same time, LI.FI has covered 10,000 edge cases you have to run into. So they will have to have all the failure rates they had with us over the past 5 years again themselves, and then they will end up with a product that will eventually be there where we are already today. And we collected so much data, and we have so much experience with this thing. Our product offering now, after having aggregated for years, will now improve step function wise. Now it goes quick. Now we are focusing on it. So now we can be okay, bum, 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 100% transaction execution guarantee. Until the end of this year, LI.FI will be extremely strong. It will be hard to go there. We do have modes on multiple levels when it comes to that.
I mean, I think it's quite interesting, like you mentioned, right? You see wallets also moving into aggregation. What I kind of, and this is something that, what's quite important to us is how do you make sure that users don't get ripped off? Because ultimately, in my opinion, if a user is getting shown a quote, they should receive that quote, right? And if we want to get users off centralized exchanges where they click and they get the quote, they don't get ripped off. They don't, have 20, 30, 50 bips more, sometimes even 200 bips worse execution. If you want to get them to trade on chain, you have to provide a good product and service.
Yes.
And it has to be that's a curse perhaps of decentralization, where there's so many providers, where there's so much competition, whereas exchanges between each other, their competition is different because they're there's no aggregation across Binance, Coinbase, and others. Well, there is.
It is.
But it's not as easy, right? Market makers do this and so on, right? But they still deliver to you what they quote, right?
We are working on transaction simulations, which works for the majority of the stuff we are doing. We are working on penalty systems and trackings. So we do everything in our hand to protect users as much as possible. And over time, there will be more and more measures where we control the DEX aggregator, or where we have good enough of a relationship. We also make sure that certain people are blocked out of quoting and so on. It's a coordination effort at the end of the day. And you need to build guardrails. And that's what we spend a lot of time on.
Do you think, I mean, last question on this topic. Right now, most quotes are dynamic, right? There's like slippage tolerance, and you usually can see like the minimum amount you'll get. And usually it's much worse. And you kind of, you as a user specify you on slippage tolerance. Most people, just take the default, which can range from 1% to 5%, depending on like what you're swapping. Why don't we see, from your perspective, more fixed rate quoting? Like we have some like in the market of these centralized no KYC swap providers, some of them do offer this. Their rates are horrendous, usually 1% to 2%, right? Which is very expensive, and you don't need to charge them.
Yeah.
It's just like a legacy thing where they haven't been challenged. Why don't we yet see, or do you think we'll see more fixed rate quotes coming into the market? We've seen from a few providers, like we've been receiving questions from partners like, hey, like whether Bob can provide this, and we actually have built a product internally that's currently in beta testing that gives you fixed rate quoting for Bitcoin.
We have
what
that
I do
too.
wonder is, okay.
We have that too. Yeah, we have clients that ask for that, and we deliver that. So fixed input output, like we have that. Often people still optimize for best price, and it's for me it's always hard to give an answer to that. And it is for LI.FI, because we have over 1,000 B2B clients. We have all the use cases possible, from the liquid fund that only moves stables, to the consumer wallet, to the neobank, to the trading desk, to the DeFi protocol. The solver that uses us for rebalancing, whatever. There's so many use cases. And so that's why demand-wise, the demand for fixed rate is super, super low. Like we didn't get the request often. Like I can recall 5 times we got it. That's where we are so right now. But with TradFi coming in, fixed rate is a must, and guaranteed execution is a must, and all of that, right? Like things will change. It really depends on who you are and whom you serve, and what are your regulatory circumstances and who's your user. So yeah, there is no very clear answer. It really depends on your customer. Is it a feature you can scale crazy? No. The demand for that is not crazy. The demand for that is very limited today. And TradFi is coming, yes, but we're still talking from a 2 years horizon until that actually matters for you and your feature. Until then, everyone has that as well. So I hope that gives you some light on this.
Yeah, I mean, it's I think, like I was like getting to essentially the point that, if you look at TradFi, right, and if people pay for things, right, and any player that handles payments, right, they want fixed rate execution. They want to have this like guaranteed delivery. Maybe a final topic before we kind of drop off. Something that's obviously close to our heart is Bitcoin and Bitcoin trading itself. LI.FI has been offering BTC swaps as well, through a few different providers. Why do one of the things that we've seen is, there is an $800 billion market a month in terms like on centralized exchanges for trading BTC. Let's say a bunch of that is wash trading, which probably is the case. Let's say it's only like 300 billion, right? Just to be really pessimistic. That's still so much more than what we see in terms of on-chain trading. From your perspective, right, looking at how other assets are traded on-chain, what's the biggest thing holding Bitcoin back? Why is the BTC volume, it's growing, but it's still only a fraction of what's traded on centralized exchanges, right? And if you look at Bitcoin as the biggest assets that most widely known, and probably almost every crypto user has BTC, why do people still go to Binance and Coinbase and don't just trade it through cross-chain swap providers?
I would argue that if Bitcoin is the gold, you buy it to hold it in the first place. Another thing I would argue is those who have a lot of Bitcoin, they're the most conservative. The whales I know, they're not even touching L2s. So Bitcoin is just a very different target group, and Bitcoin is a different kind of asset. So that's what it is. Like that, the Bitcoin whale is not the one operating on Pendle. It's not. Like majority, probably not, right? And then so the demand for that is, and then it's just low. And then at the same time, Bitcoin. Why do you buy into Bitcoin? Like Bitcoin is not the 10x upside tomorrow. So buy it to hold it. Very simple.
But so that all makes sense. I will challenge the part of Bitcoin like is dominated by BTC whales, because but Bitcoin has the most widest distribution in crypto. And if you go to an ETH conference and you ask people like who has BTC, right? It's been done many times between ETH and Bitcoin maxis, and ultimately both communities have both Bitcoin and ETH at this point. But if you buy BTC or if you sell it, right? If you trade it, if you want to buy more, why do still, because ultimately the trading volume on centralized exchanges is it's non-negligible, and it's the highest. Bitcoin to stablecoin volume is the largest out there. We've seen much more conversion of like in terms of like DeFi liquidity and DeFi trading volumes on like ETH and other asset stablecoins. Why is Bitcoin proportionally still lagging behind? Like you mentioned speed, which is a legit point, but we have wrappers, right?
I didn't even mention speed. It's just like it's the type of user that holds a lot of Bitcoin, and then on top of that, it's why do you buy Bitcoin? Like you don't buy Bitcoin to sell at the next high, because it's not done yet. Like if you buy into Bitcoin, and typically out of conviction, and so you buy it somewhere where it's safe, which typically people feel the centralized exchange is a safe spot, and then others store it in their hardware wallet, and that's just where this is safe, and it's your hedge against all your degen play. Then the degen play simply doesn't happen in Bitcoin. Then money markets are also not that widely available for Bitcoin. So in general, you have a chicken egg problem with any asset, right? Like the utility of each asset depends on how many money markets and whatever are available to do something with it. Then there's probably the general downturn of DeFi we've been seeing in the past 2 years. Many projects died, couldn't raise another round of that. So DeFi reduced a lot. The asset is bought from a different lens, and therefore it's more about holding it, and it's your hedge against all your degen play, and it's a hedge against the dollar or whatever your home currency is. And then typically, if you look about the big backholders, whales operate differently, and they don't engage with money markets at all, and they don't want to use bridges. They don't even want to use an L2 in the first place, or another L1. So that's where it starts. And I think that's just it. It lags behind because it's just not bought for the reason you want it to be.
Well, I guess, like the interesting point here is that, you meant like people don't actually hold Bitcoin on centralized exchanges that much anymore. And if you look at the statistics, over 50% of the Bitcoin in supply is actually held off chain, not on the centralized providers. So the statistics are like 10%, and then exactly Ledger, right? So Ledger hardware devices and cold storage custodians.
Yeah.
Custodians you can take out, because usually they provide their own OTC desk. Big players, big whales who hold with custodians, they will just use the OTC desk that's provided to them for the custodian. But if you look at I would say non-negligible population of Bitcoin holders that have BTC in their ledgers, their Trezors, and like other hardware devices, other wallets, like you see, like, to be fair, and the interesting point here is that Ledger is one of the top wallets that actually accounts for Bitcoin cross-chain trading volume. So you see that these people actually do trade, but it's not proportional to the amount of Bitcoin being held. Do you see more people trading and buying and selling Bitcoin on chain, or from your perspective, is that market not going to grow? Because obviously we're opinionated. In my opinion,
I think the market will grow, but it's gonna be a slow process. I think TradFi will come in. TradFi will try to own certain money markets and deploy capital in there, partially in Bitcoin, and that is when Bitcoin utility will rise, and that is when you're gonna see more cross-chain movements of Bitcoins. We still see bridge hacks like KelpDAO. We saw this thing now, we haven't seen bridge hacks in a while, actually. We were on a very good path, and now we saw one again, right? With an entity that is claimed to be enterprise and super safe and super professional and so on, and everything was handled non-professionally. I like the team, don't get me wrong. I just, but it's kind of, yeah, this holds us back. It pushes us back again as an industry. So I think you're on the right track with Bob. If you want to have my candid opinion, the very German way, I would say you're 3 years out from seeing the utility you want to see.
I mean, Bitcoin is certainly, and that's, I think, one of the biggest issues we've seen with the Bitcoin L2 market. And what frustrates me the most is a lot of people got into Bitcoin thinking, they're going to launch something and they're going to win immediately. Like, Bitcoin is the biggest market out there, right? You're playing at the big stakes table, you're competing with institutions, you're converting a very conservative user base, but it is the user base that has the most money in the space. It's not like you can win. You can come in, launch a project, and you immediately kind of capture the entire Bitcoin market, right? It's much more rigid, it's much slower, but also because it's a much bigger market that you have to convert. But if you do win on Bitcoin, I think that's what drove, like, at some point there were 80 Bitcoin L2s, right? What drove, apart from the opportunistic and can raise money with the top, like, what drove people is, like, if you win on Bitcoin, like, it's a very easy thing to sell to yourself as well as a founder. If you don't win on Bitcoin, you win the entire market, because, right, if you convert 10% of the Bitcoin trading volume, right, you become the biggest player in the space. But it's not easy, right? Like, there's not many players who have survived and were still around. Like, when we started building Bob, Bitcoin L2s were dead, right? Like, we had stacks and rootstock, and people were kind of not really caring too much about it. And then we went out to raise capital for because our opinion was like, yes, it must be solved. Like, it can't be that I have to go to a centralized exchange to use Bitcoin for something else. It can't be that the only way to do Bitcoin DeFi is wrap BTC on Ethereum. Like, there must be a better way to do this. But it took us a long time to convince people. And then suddenly, like, we raised a round and we started building and launching Bob, and suddenly had 80 projects. And now what do you have left? A lot of them are gone, because it's like, Bitcoin is if you're trying to get in and solve it quickly, it will chew you up and spit you out. So I don't disagree with Bitcoin generally taking longer to gain traction and adoption, like, in terms of getting people on chain. But I do believe that it's the best tool we have to get more users actually into DeFi, because if you look beyond the DeFi bubble, what's the thing that people actually know about crypto? It is Bitcoin. And if you can abstract the complexity, like the DeFi mullet that everybody's been talking about, that's, I think, where, that's what people will come in first to do, like, buy Bitcoin, borrow against it, maybe Ethereum, maybe Solana, but all the other assets that exist out there, people don't know or don't care about them.
Yeah, I agree. Buying into Bitcoin, certainly, Bitcoin has the biggest brand out there amongst consumers. So I agree. They're going to buy into it. Does it mean bridging? No. They wouldn't even understand the term bridging.
But that's the thing, right? Like, bridging is such a thing. Like, it's like, ultimately it's trading, right? Like, where do you buy your Bitcoin? Do you buy it on Binance? And the question what we want to achieve is, like, you buy it on whatever wallet you have, you buy it through Ledger, but you don't have to go to Binance, to Coinbase directly. You have other options, which allows you to, just buy it and lands in your Ledger automatically. And the rise of stablecoins actually, I think, is a big contributing factor here, because now no longer, it's much easier to get into DeFi, into stables. It's much easier to go on chain, because stablecoins are so much easier to acquire. Previously, on-ramping was such a big problem, right? You had a few providers that dominated the market of centralized exchanges. Rates were very high. Now, with regulatory clarity happening, there's so many more players that can provide you with an on-ramp and give you a stable coin. And once you have a stable, there's no need for you to go to Binance or Coinbase or another centralized exchange. You can just trade on chain. So maybe it'll take 2 to 3 years, but we certainly think that trading will be happening on chain. The big question is, will people trade Bitcoin on chain? Because it is actually not, if you trade stables versus Solana or ETH, it goes like this. With Bitcoin, it's still slow and the UX is so broken. But to wrap it up, because we're really getting close to the end of the show, and obviously this has been a hot topic, and we're talking about, KelpDAO is the security incident, which it's called a bridge hack, but at the end of the day, it was essentially key mismanagement, right? On one hand, but then also very sophisticated attack on the RPC nodes. And I haven't seen these such attacks in the wild actually before. So it's quite a big one. Do you think, switching gears completely, do you think AI will help us actually secure systems? Or is it more of a sword and it's going to break more things? Because obviously there's two ways this can go. Either it helps us be secure, it just,
You need to break things in order to secure things.
Fair point. So your take is, you think, but what's your opinion?
So the question is, who does it faster, like the good side or the bad side? The big problem is that AI is not evenly distributed. So it is actually problematic from a standpoint that you will have, there are people out there, there's system admins out there that haven't touched Claude. They don't know what's coming. Systems that are managed by some people that just, there's so many outdated systems. This planet runs on so many outdated systems. It's going to be brutal. It's the truth. So we have to do as much as possible to enforce updates. I think we have to change policies around how updates are being run. Probably, it's going to be really messy. I see AI as a chance. We use it. We use it a lot, and we also use it to secure our systems. And we are very avid when it comes to updating dependencies, making sure can we update it and whatever. But yes, it will be messy for those who do not have access, which is the majority of the world. So
I think crypto hacks, as we've seen them, and again, it's a bit hard to attribute them directly to the rise of AI, but it is quite notable how many smaller exploits, smaller chains are getting hit, smaller protocols, and that just has to be somehow linked.
Unmaintained.
Exactly, because now it's like, previously, who would get attacked? Like it was quite a bit of effort to actually hack a DeFi protocol. Like if it was a bigger one, and Lazarus would notoriously go after the big ones, and like other hackers, would generally also hit the big protocols. But now we've seen like 100K here, 200K there, 1 million here. And it's just, it feels like somebody's just got a list of which protocols are out, haven't been used, and like where there's money inside, and just, okay, let's see what I can get. Let's see what Claude can get for me.
Yeah, I agree. It's literally, I think it was the same week of KelpDAO, we saw 10 other hacks, right? KelpDAO was around 300 million. And at the same time, with another 300 million based on smaller hacks in the same 10 days or something. Like, it was ridiculous. And it was simply, yes, but that was certainly driven by AI. Like, who has not maintained certain front ends or back end logins? You can screen for back end logins and then screen for JavaScript libraries that are being used. That gives you an indicator on how the stack looks like and at which versions these things are. Yeah, unmaintained products for sure, but that is a learning curve as well, and we just have to eat that. When in regard to crypto, all these hacks we have been seeing are cute. Traditional finance has seen these hacks too. It was just difficult back then to pinpoint finger at it in the public space and globally. We didn't have Twitter back then, so all of that.
Back then it was
hacks,
social engineering, right? Back then it was social engineering getting
not
to
only that.
systems.
Oh, not only that. It was also just hacks, literal just hacks. Like that was happening too, and at huge scales. So what we are seeing crypto so far is still a joke, and the money we move is so small. Like that crypto is so small compared to traditional finance. If no fucking idea, like the Fed or DTCC, what they are settling on a daily basis, like 4 to 8 trillions. It's so far. We do that. We do one in a month, or what is it? It's we
But it should be a wake-up call, right? Because like what we're seeing right now in crypto
That's the
is
thing.
like, I think it's just the start, right?
Yeah.
And it's easier because the things are open source, and yes, you can get access to closed source systems, and you know, where there's additional gatekeeping. And to be fair, realistically speaking, if it's not a one of a multisig, centralized systems tend to be a bit harder to attack if you have like a multisig, right? Why have custodians operated securely for so long without any major custody hacks? Bybit excluding, which was a very sophisticated attack, right? The attack surface is actually smaller, but DeFi protocols, you have on-chain execution, you know, their attack surface is a bit bigger. The big difference, in my opinion, between like DeFi and like trust minimization through protocol logic and code versus like centralized providers is protocols that survive over time, in theory, right? They get more robust, more people have used it. It becomes like battle tested, edge cases are patched. And the longer you survive, the less likely something's going to go wrong. Whereas with centralized players, like it's very hard to attack a multisig, realistically speaking, right? There's so many multisigs out there, and if they're properly maintained by companies that specialize in running a multisig, right? And there's many players who are multisigs have no idea what they're doing, but custodians and institutions that, you know, just do this properly, hard to attack. But then the other issue is that people just get corrupted over time. And we've seen more of this over the last decades. And I think the damage from corrupted institutions in crypto and other places is much higher than the hacks combined. So I still think DeFi is you know, the right way to go, but we're definitely going to see changes. Otherwise,
I think it's healthy. Honestly, I think the space has been way too unprofessional for way too long. I am for everything that disciplines these people, that raises the bar to launch your project and your token. And we need more discipline. We need to be more serious. So I am actually not opposed to any of that. I'm like, let's go. Let's, you know, we need to be more, we need to grow up. The space has to grow up. So I'm all for it. Let's get these projects get hacked. It's fine. It's fine. Let's sweep them out. Let's make sure that those who have that take it seriously. We had our lessons in the past, and it was transformative for us as a company. So all these things let you grow. So you this space needs this. So I'm looking forward to AI to be more present in the security realm on both sides. Right? You will only end up getting stronger out of it on the other end.
Definitely. I mean, I remember when I got into security and we had these CTFs. I think at this point, right, the CTF challenges are kind of dead because you could just run AI on it. But yeah, Philipp, thank you so much for joining in today. And for everyone else listening, we'll have a next show coming next Wednesday with another special guest. So definitely stay tuned and sign up and follow us on Twitter. Thank you so much.
Thank you so much.